Welcome, Kuppy.
Hey there, how's it going?
Hey, thanks for joining us today. Happy to have you.
Hey, thanks for inviting me to speak.
Absolutely. So, where do we find you today?
Oh, I'm in Miami. I'm home for a change. It's one of
Oh,
those rare
nice.
days I'm in Miami.
Nice. Well, in a bit, we're going to get to some of the places you've been recently. What I want to do is I want to start with a little bit of a history. I told our listeners a little bit about you, but why don't you tell us your history with Obras, what was previously Seraphin Capitalist Exploits?
Yeah, sure. So you guys originally came and visited me out in Ulaanbaatar, Mongolia. It's about 8 years ago. I'd been reading what was Capitalist Exploits at the time. I'd been reading that for much longer. I invited you guys out there. At the time, it seemed like a pretty good place to go invest. And since then, I've stayed a long-term reader. I've visited in Colombia, in Austin. I'm going to Panama next month, or I guess in 2 months, and really excited about it.
Well, that was a cue I was looking for in terms of promoting Panama. So uh, we love having you come and join us. We love having you speak and hearing your perspective, but we also just love being able to hang out with you. So we look forward. I personally, and I know others are looking forward to that for our meetup in Panama. So you have a very specific approach to investing, and rather than me going into great detail about it, why don't you tell us about your strategy and how it's worked for you?
Yeah, sure. So the way I think about the world is that over time, the opportunity sets keep moving and you have to evolve with the opportunity sets. And right now, where I'm finding the best opportunities are in blowups. These are stocks that are down a lot. These are in sectors that are hated and despised. These are in equities where a portfolio manager says to themselves, it's probably dead money this year, and I have performance pressure because I have to produce, quarterly, weekly, sometimes daily performance numbers to keep the assets under management I have, and I just can't be in a company that doesn't have a clear catalyst till next year. And because of the way the dynamic is in fund management today, you have a lot of these stocks that are great businesses. They're undervalued. They're substantially below where the private market values would be. Yet fund managers just can't own the things. And I just keep finding opportunities in those sort of places, which is very different from when I started my career, where the opportunity was small, illiquid growth companies where you had these portfolio managers that said, this thing doesn't have enough trading volume, or, why am I going to waste an analyst's time to look at a company that's below 100 million market cap? And you had all these great businesses that were growing very fast, and they're trading at 5, 6, 7 times earnings and growing 50 or 100% a year. But yes, they had a 50 million market cap and it traded 100,000 a day. But at the time, 100,000 a day was enough liquidity for my needs. And a lot of these ended up being 5 and 10 baggers. Since then, a lot of other people have gravitated to that sector. A lot of computers have gravitated to the point where you don't have to spend an analyst's time looking at these companies. And these things now trade not just on multiples of earnings, but even multiples of sales that make no sense. And I've still found a few winners there over the past few years. If you follow my blog, Adventures in Capitalism, I wrote about quite a few of these. TheJoint.com was better than a double within a year. Viamed was a triple in a year. I've found a few of these over time, but for the most part, the opportunity is in stocks that are just down a lot, sectors that are down, companies that are hated, particularly if it's very difficult to model quarter by quarter what the earnings will look like. Something like an energy stock today, if you don't have the inputs you need, because no one knows what the price of energy will be, I'm talking about oil and nat gas tomorrow, much less a year from now or a quarter from now, no one knows how to model these. And since you don't have a linear ability to model, they just slip through the cracks and they're all horribly undervalued. And that's where I've been finding the opportunities these days.
So how do you know where to look? I know you've been doing it for years. So give our listeners a little insight in what you're seeing and how you find these companies.
So I guess I'm kind of embarrassed to admit it, but the best way to find really, really cheap stocks is to just talk to your friends. I'm very lucky. I've been doing this for almost 20 years now, and I have a lot of really smart friends. And just sitting around beers and talking to them. And I kind of asked the same question: what have you bought this year or last year that you're down a lot on? And they say, oh, there's this stock and it's so cheap. And then it dropped by half. And, that's what gets me excited, because it was really cheap and now it's even cheaper. And here's someone who I know who's really, really smart, and I could buy it at half what they paid. And that's really where the best opportunities are. Just looking through what your friends already own, they've already done the work for you. You could just look through a portfolio of 10 or 20 names they have and cherry pick one here and two there, and try to have a best of portfolio with the names that are down a lot. Outside of that, I'm usually scanning through the usual places: Seeking Alpha, Value Investor Club, SumZero, lists of new lows, new all-time lows, blow-ups, corporate events, change of CEO, change of strategy, spin-offs, all those sort of event-driven strategies. But I really tend to find that the best stuff just comes from looking at my friends and seeing what they're suffering from.
Wow, you really look for the negative, don't you?
But I'm not curmudgeon or anything.
No, and you don't tell them that you've bought at half what they paid for.
No, I of course I do. I brag about it, but
and yet
that's where you find great ideas. I'm sorry to admit it.
So I do like your point, though, because I think of the Oberst community. That's how we do it as well. Is that you're with your friends and you're sharing where you're gaining and where you're losing, and we learn from our friends. So I was expecting something much more educational, something really deep. But, I appreciate that. Hopefully, as we get further into the podcast, folks we'll hear more about kind of where you're coming from, because I know it's not that you're just looking with shallow eyes. You really do have some deep-rooted
of course
strategies. Something that you refer to is, I think you were going to say something, so I'll
I was just going to say, like, once you have an idea, that's only a starting point. From there, you have hundreds of hours of work, reading filings, talking to people in the industry, in the sector. You don't just take something that's down a lot and hope it recovers. But at the same time, if my friends have already done a lot of the work, they can send me their spreadsheets, their analysis, their talking points, all the data they've analyzed. There's too many companies in this world for you to just sit there and start from scratch. You need friends, you need contacts, you need relationships. Otherwise, you're just going to be sitting there with a download from Bloomberg of all the stocks that made new lows this week. And that's always a good starting point, but it doesn't really tell you anything. You have to go learn couple hundred companies simultaneously. You won't even make it through the A's and B's before the next week starts. And, you're not going to be very productive that way.
So you are known for choosing, I believe this is your words, exceptional companies. So you're looking for companies amongst that wealth of companies that are struggling. You are looking for specific traits in those companies. What do you consider exceptional companies, or what are the traits?
So I guess there's two parts to this. Going back to where I was 15 or 20 years ago in small growth companies, I was looking for companies that were growing fast, that had some sort of a moat, that had a CEO with a lot of equity vested interest and high returns on capital, and the usual stuff that people look for. But I was looking for it in a mid-single digit earnings multiple. Yes, it's very easy, and if you find one of those, you buy as many shares as you can because you're going to make a lot of money. The odds of you finding one, you're going to find about one every year, and that's with looking at hundreds of these. What I spend most of my time on are these blow-ups where, you're not looking at the best companies. They're not the best businesses. You know what you're getting into. You're just hoping to buy it so cheap that you can't get hurt. And these aren't the cigar butts that are going out of business over the next few years. These are cyclical industries where you know what the problems are. What you're trying to figure out is what makes it get better. And just because something's down a lot doesn't mean that it's going to go back up. Sometimes something that's down 90% can drop another 90%. What you need to figure out is, one, what the balance sheet strength is so that you have enough runway to see the sector or the company or whatever it is. You need to be able to see the recovery. So you need a runway, which means you need liquidity. You need to make sure there's enough asset value that if they need to borrow more money or do something else, that they're not just going to dilute you. Then you need to see something that tells you the sector is turning. I think a lot of value investors just go into a stock that's down a lot and they say, look, it's really cheap based on asset value, or it's cheap based on some other metrics. And that's all great and good. There's a lot of undervalued companies. I mean, there's a lot of companies that trade for less than cash right now. It doesn't tell you anything. What you need to know is why it's going to get better. And that's the real hard part, because sometimes these sectors never turn. There's industries that'll just melt away for the rest of my life until they don't exist anymore. And there's other industries that really will turn. And the good thing is that usually you're in these sectors that no one cares about. And we're going to talk about some of those sectors later, but everyone who's bought for the last few years has lost a lot of money. And there's no new capital coming into the sector. People are just mentally worn out of hearing about the sector. So that when the turn comes, yes, the stock will start to rise a little, but you're going to probably be able to buy it 10 or 20% off the low. You don't have to get the low tick. You have to get it when you have a very high confidence that there is a turn coming and that you can see the light at the end of the tunnel, that things are getting better. Because yes, you can own it and buy the absolute low tick and you can sit there, but it might just bounce along the low for 2 or 3 years, in which case your IRR is terrible. But what I've always learned is that the move from really shitty to sort of shitty is usually a huge percent move. Remember, going from down 90 to down 70 means you triple your money. And you don't need to recover all of the original investments. Sometimes with these cyclical industries, they actually go back to the old highs and beyond. But just capturing that recovery is a huge percentile change. And what you're trying to do is figure out how to do that in a timely way, so you don't have to just sit there and wait, that you can actually grab the juicy part, which is the recovery.
In your experience, how long do most of those end up taking before you've actually capitalized on that recovery?
So there's a lot of really smart people in the stock market, and they work really hard. And what I've found is that the first quarter of recovery, you might get a little bit of a bounce, but there's always this view that, there's been a few false starts and then things got worse again. And, you don't really see that bounce, because what happened is so many people got so burned for so long. And usually there were false recoveries. And so it's not the first quarter, sometimes not the second quarter, but by the third quarter that you have sequential progress in whatever sector it is, people start to notice. If not people, computers start to notice. Remember, the world is full of creepy crawly things that go through all the filings and just buy based on sequential change. And so by the third quarter, you will start seeing a recovery. Oftentimes, these things have short interest in them. I don't know why you'd short a stock at half a book, but a lot of these things do have short interest just because that trade has been working for a while. So you have shorts that need to cover. And you start to see that recovery that I was talking about previously. But it usually takes about 2 or 3 quarters, which means you have plenty of time to figure it out. You don't have to just buy on the low tick.
Do you ever short?
Not really, no. I shorted in 2007 a bunch of financial stocks that no longer exist. And I was about a year early calling the financial collapse. And a lot of these companies doubled and tripled before they went bankrupt. And I learned a very good lesson. Occasionally I'll buy puts. I own some puts on Tesla. But for the most part, I don't do that. What I've learned is that if a company is going to be a criminal enterprise and they're going to fake all the numbers, they'll just keep faking the numbers. And you're never going to be able to figure out what the catalyst is that finally short circuits that process of being able to fake numbers and raise additional capital.
Let's dig into something practical. Let's look at one of the sectors that I know has been on your mind, and then build upon what you were just sharing with us. Shipping industry. That I know is something you've focused on lately.
Yeah, let's talk about shipping. Let me start with a caveat, I guess, or a disclaimer. It's a terrible sector. No one should ever own shipping stocks as a long-term investment. They will 100% of the time destroy your money. Between related party interests and the fact that shipping in general destroys capital, it's just one of the worst places you could possibly invest your money. That said, every once in a while, you can make phenomenal amounts of money. That is because shipping in general has 2 characteristics. One being that there's a massive amounts of financial leverage, which means when you're right, you're really, really right. And 2, you have the factor that there's huge operating leverage, because operating a boat is almost 100% a fixed cost business. So incremental revenue goes right to the bottom line. And what that means is that when things go well, you could have a boat that, just take an arbitrary boat, has 10,000 a day of operating costs, including SG&A. For multiple years, they'll only earn 9,000 in charters, which means they lose $1,000 a day times 365 a year. You're talking about a lot of money to just hold on to this stupid boat that's also depreciating while you're holding it.
Mhm.
And then if the shipping rates go to 100,000 a day, you're making 90,000 a day times 365. And you're making an obscene amount of money, and that'll last for maybe a few weeks, a few quarters. At some point, they're going to produce a whole lot more boats, or they're going to change the demand for the boat. And, you're going to go back to losing money for the next decade. But during that brief glimmer of profitability, you can make obscene amounts of money, especially because these things are usually leveraged multiple times. For the last decade, I guess basically starting in 2006, there was a massive spree of ordering of new vessels of all types. These vessels started showing up on the market in 2008, right when the world economy got a little shaky, and they just kept showing up. QE, zero interest rates, negative interest rates, all that meant that people would just keep ordering more boats. Then you had the Chinese, the Koreans, they all subsidized their shipyards by providing cheap financing and pretty much ignoring insolvencies in the sector so that they could make work programs. And what this all did was led to an epic glut of vessels of every type for the last decade. And basically no one's made money in shipping for the better part of 15 years now. And it's just been an awful run. And if you look at any shipping stocks, most of them are down 99.9%. They've had to raise money multiple times. They've recapitalized. Some of these have been in and out of bankruptcy twice now. It's just been so awful that no one even pays attention anymore. But here we are, and the number of new vessels coming online has slowed to a trickle. A lot of the shipyards finally went bankrupt. So even if there is demand for new vessels, no one is around to produce them. The global economy keeps growing a few percent a year, which means demand keeps growing a few percent a year. So you have demand growing and you have almost no supply. And a lot of the vessels that were delivered in 2006, 7, 8, those vessels are now 15 years old. And they're going to need special surveys. They're going to need ballast water systems installed, which costs money. And finally, you have IMO 2020 coming up. And what IMO 2020 says is that starting January 2020, which is next year, all vessels need to have a scrubber, or they need to burn low sulfur fuel. And low sulfur fuel is substantially more expensive than the current high sulfur bunker fuels that they use, which means that people will either install scrubbers at the cost of $2 to $4 million a vessel, or they'll have to burn this much more expensive fuel, which is going to add a few $1,000s a day of operating costs to a vessel. And when you think of a vessel that's, say, operating at 10,000 a day all in, adding 3,000 or 4,000 is a substantial increase in costs. And what I believe this will do is a number of things. One, it will lead to a lot of older vessels getting scrapped because they're not going to make the investments in the scrubbers. Two, I think you're going to see a lot of guys slow steam their vessels, which means they're going to go slightly slower. So if all the vessels go 10% slower, they save a lot of fuel. And at the same time, which lowers the operating cost, but by going slower, you need that many more vessels on the water. And that will restrict the total supply globally. I think you're going to see a couple other changes happen. For instance, just putting your vessel into dry dock to put your scrubber on is going to reduce supply because those vessels aren't going to be operating while they're getting the scrubber. And I think you're going to see a situation where supply, which has been oversupplied for the better part of 15 years, is going to finally start to get constricted right at the time when demand is actually increasing. And I think there's going to be a lot of opportunities in shipping. Shipping kind of bottomed in Q1. A lot of these stocks are up a bit from the bottom, but they really haven't started moving. Most of them haven't really even earned any profits yet. It's just in anticipation that IMO 2020 will be a catalyst to make things better, or as I said earlier, less shitty. And do you want me to talk about Scorpio real fast?
Of course.
So Scorpio is my largest position. It's up quite a bit since I purchased it. My cost base is around $17, and we're about 26 today. But the stock still trades for less than book value, which is in the mid 30s. So you're buying a bunch of steel for about 70, 80 cents on the dollar for the current market price of these boats. But Scorpio is the biggest player globally in product tankers. And product tankers are the type of ship that will be used to transport this low sulfur fuel. And demand for low sulfur fuel is going to increase by about 3 or 4 million barrels a day. And that increase in demand is going to lead to a substantial increase in the need for product tankers. At a time when there's very few new product tankers on order, you have a lot of product tankers that are likely going to get scrapped. You also have a lot of product tankers that are north of 15 years old that aren't going to be able to be used in the clean trade markets. Plus, I think the IMO 2020 in the first couple of quarters of implementation will create quite a bit of chaos. And that chaos is always good for shipping. Disruption means that vessels sit at port, they sit offshore waiting for product to move, and any of that sort of stuff dramatically increases charter rates. We saw the summer of 2018 was the lowest tanker rates for product tankers in decades. And by the fall, tanker rates had already recovered to 10-year highs. This year in the spring, we had a spike back to 10-year highs. They've since come off quite a bit. We're right now at the low of the year, but that low is being caused by refinery maintenance. And I expect that in Q3 and Q4, we'll see 10-year highs and maybe even 20-year highs. I think there's a fighting good chance that Scorpio earns more than its market cap next year.
So if you were speaking to a novice at the shipping sector, what guidance would you give them for where to even start exploring and looking for their Scorpio?
Well, I would start by looking through all the subsectors. I think that a lot of investors make this mistake of thinking of shipping as being this monolithic sector, which it is. But what's good for the Baltic Dry Index isn't going to always be good for the Baltic Clean Index, which might not be good for LNG tankers. They're all their own separate things. So start there. Analyze the different subsectors and figure out which ones have favorable supply-demand characteristics. Mm-hmm. Some have very rapidly growing supply, some have rapidly growing demand, some are going to be victims of the trade war that seems to be escalating, some will be beneficiaries of this trade war. I think you need to look at what's happening and analyze which subsectors you want to be in. From there, I would look at the individual companies. Each subsector has multiple companies. Try to get familiar with the assets they have, the balance sheets they have, their liquidity runways, particularly the personalities involved. Shipping is pretty notorious. I'd say it's actually worse than junior mining for attracting true criminals. And just get a sense for who these people are, what they're trying to accomplish, what sort of related party deals they have with the company. Almost all these companies are getting looted in some way. And just try to figure out how you can get comfortable with the people involved. In certain cases, I've gotten comfortable with the people involved, and there's certain people I would never want to be a shareholder of a company they're involved in. But I think if you piece your way through it, there's a lot of opportunities. A lot of shipping stocks trade at half a NAV still, even though they've rallied quite a bit. At one point, they were at a quarter of NAV, some of them. And when I'm saying NAV, that's the current market value of these vessels. And the vessel trade market is a very active market in the sale and purchase market. And you can pretty quickly triangulate what the true values are, adjust it for cash and debt and other on-balance sheet assets and liabilities, adjust it for current charters in place, whether they're above or below market, and then figure out what the true value of the company is. And just a point that the stated book value oftentimes has no relation whatsoever to the current market value of the vessels. Stated book is just the purchase price minus depreciation. So don't get caught up on that section.
You sound like a successful detective.
It's a full-time mission, and I kind of enjoy it.
Oh, obviously so. But I think that's great advice to the rest of us, and for really any of us involved with investing. It's whether if we're just relying upon other people, that's one thing. But if we're actually going to do our own work in identifying companies, sectors, and then companies, I think that it'd be worth someone pushing this into the slow mode and taking down notes on the way you've just walked through how you found Scorpio in one sense. Well,
let me tell you how I found Scorpio. I had been reading about this IMO 2020 change. I had been well aware of it for the past few years. And from there, I said, there's going to be a huge increase in demand for product tankers. And I started learning about the sector, learning about what was going to happen with refining, just trying to educate myself. This has been a multi-year process in regards to Scorpio. And I've just been watching it, but I'm not the only one who saw an increase in demand for product tankers. All the shipping companies saw the same, and they ordered a bunch of vessels. And the thing is, a lot of these vessels showed up on the market in 2017 and 18 and really depressed the market, and subsequently led a lot of these companies to blow covenants and have to raise more capital. So by buying more vessels and getting ready, they basically screwed over their shareholders. Welcome to shipping. But now you don't have a lot more vessels on order, and the catalyst that these guys all ordered these vessels for is finally happening. And I've followed shipping for 20 years. I knew enough not to buy until these vessels had made their way onto the water, and you saw rates starting to strengthen a bit. And so I just been sitting there watching. I'd met with the management team of Scorpio a few times, and I was just waiting for the right moment. And when tanker rates started spiking in November and December, I knew that was the time. And that's when I made my first investment. But I've been watching it and kind of stalking this thing. The stock, it's since had a 10-for-1 split, but I've been watching the stock since it was about $6 or $7. And I bought mine when it was $1.70.
Good for you. Good for you. So before we move on to a different topic, what are some other sectors where you're finding value today?
All right, let me talk briefly about energy. I find it truly fascinating that if you overlay a chart of any sort of energy index of the equities, and there's a lot of these ETFs, with the price of oil, they sort of tracked each other for the better part of a decade or two. And then really recently, there's been a divergence where the price of oil is up quite a bit off the lows. And none of these energy stocks have recovered. And I think there's a couple of reasons for this. One is that a lot of these energy companies overpromised and just lit money on fire. And I think a lot of people lost a lot of money. I think there's a lot of energy focused hedge funds that got liquidated in 2018 near Q4. So the number of people that watching this sector is less. It's a very complicated sector. Generalists like myself don't always understand it. I'll tell you that I'm a novice myself. But you have a lot of equities that are down quite dramatically. The price of oil is up quite a bit since then, and these companies haven't recovered. And that gets me quite excited. You have a sector that's just destroyed a lot of capital for a long time, and no one is looking anymore. And I'm going to talk about a company called Sandridge, which is, I believe, my second biggest position. Sandridge is a company that went bankrupt, and the guys who were running it literally just lit money on fire. They spent $12 billion drilling holes that mostly were uneconomic. They spent $100 million renovating their corporate headquarters. They spent $26 million on a Zen garden next to the corporate headquarters. You can't really make up some of the stuff they spent money on because it's so insane. Then it came out of bankruptcy. Most of the debt got eliminated. And this fellow named Carl Icahn, who is one of the smartest people alive, at $17 a share out of bankruptcy, he bought 13% of the company, kicked out management, and took control. Put 5 of his people on the board, and he controls the board. Then Q4 2018 happened, and the stock dropped from $17 to $7. And here we are where Carl Icahn's cut costs, improved the business, gotten rid of some non-core assets, moved the pieces around. He's created a decent amount of value in not so much time, put a new CEO in place, and the stock has recovered from 7 to 9. Now, my average is about 8.5. And when you look at this company, it's got a $300 million market cap today. The corporate headquarters is worth about $100 million. So it's got about a $200 million EV. There's a little tiny sliver of net debt. So about $200 million EV. I think they're going to do about $200 million of cash flow this year. And you're buying it at about 1 times cash flow. There's really 3 components of it. There is a Mississippi Lime asset, which is producing cash flow and somewhat in runoff. It's a nat gas mainly asset. You have Northwest Stack, which has a drill co, so they're using someone else's money to drill holes for them. And then finally, you have assets in Colorado, which have done a good deal better than originally expected. And they're putting money into those assets and drilling them. Gun to my head, I would be buying back stock here at 1 times cash flow. It's way too cheap. But Carl Icahn's smarter than me. And in some cases, I just delegate the responsibility and hope he does the right thing. And so anyway, I mean, look, going back to what I originally talked about, where you go to your smartest friends, I've never met Carl Icahn. I wish he was my friend. But here you have one of the smartest people alive, and I bought a bunch of stock at half of what he paid. And we all know he isn't stupid.
He's still in it. Clearly, he's still in it.
Yes, he's still in it, and he's definitely not stupid. So, I mean, when you have a chance to do something like that, where you can buy in at half of what one of the smartest people alive paid, you're smart to do it. And I love these sort of situations.
Wow. Well, okay. So this is an instance where you're really kind of following his stream. I believe you also get actively involved in some of the companies in which you invest. Is that correct?
Yeah, sometimes. I try not to usually. I don't see myself as an activist. And I've actually found a lot of activists are almost counterproductive in that they yell and scream about something and try to fix it. But the problem isn't really the management team in place. It's just that they bought into a bad situation.
Tell us about EMEA.
So EMEA was my biggest winner last year. It was a situation where I had to get actively involved. It wasn't going to solve itself. And you had a situation where this company was just run by morons. And they were having a fire sale of assets to their drinking buddies. And they actually sold one asset that was profitable for a negative price, which I've never seen done in my entire career. They actually paid someone more than $100 million to take a division off their hands that produced $50 million. And I said to some of my friends, we have to get involved here. We have to do something. And eventually I took it upon myself. I'm not an activist. I didn't want to hire lawyers. I didn't have the money to do that or the time to go file a bunch of documents. And I just said, let's run a no confidence campaign against these people. In Canada, if you don't get more than half the shareholder votes, you have to resign from the board. And so I wrote on my blog, Adventures in Capitalism, that I have no confidence in these people. They're criminals, and you shouldn't vote for them. And a funny thing happened. All these other guys that own shares start calling me up. And these are guys who own 7- and 8-figure positions. They're saying, yeah, our firm never really votes. That's just not what we do. But we have 3 million shares, and fuck these people. We're going to vote against them. And we actually got 48% of the vote. A friend of mine saw my article. He wrote a press release. I got some journalists in Canada to do an interview with me and basically let me explain why I was voting against these guys. But we got 48%. We almost got enough to have these guys resign, which is surprising because the idea of having this no confidence vote hadn't even come to me until a lot of people already voted. And when you get to be that close and it's a large, high-profile situation, I think board members, they look at their legal risk. And we had a situation where the CEO resigned, a number of board members quit over the next year, and adults finally got into control of the company. They hired a new CEO, well-respected hedge fund or asset manager out of New York who had the largest block, got 2 board seats. And finally, had adult supervision. And from the time I launched my withhold vote campaign until the results came out, about a month after that, Air Canada bid for the whole company. So from the time I started my process till about 6 weeks later, the stock more than tripled, which was quite good as it was my largest position at the time. And one of the reasons I was up so much last year. And it taught me a really good lesson that if you're going to be an investor in the stock market, you can't just own a few shares. You have to be willing to throw your weight around. You can't be a victim. If you end up in a company with true idiots running it, And you never really know until you see these guys do something. You have to be able to go out there and threaten to go activist. You have to be able to afford the lawyers, and you have to be able to buy a big enough block to do something about it. And with Aimia, I was just managing my own money, and I just didn't have enough shares to get angry publicly in a way that I could force the issue until I did the no confidence. And that's one of the reasons I decided to relaunch my hedge fund. Not because I really wanted to manage huge quantities of capital, but I wanted to know that if I ever had to call up a CEO and say, I disagree with you, I had the force of weight that I could say, I'm going to go to 9.9 or 19.9, and we're going to go hire some lawyers, and we're going to get rid of you. And I didn't have that ability before. So, that's why I've relaunched my hedge fund.
Sure.
And that's something I've learned. You need to have that big stick, and you don't want to use it often, but you need to have it.
We're going to hit on that in a few minutes, but what I want to make sure is that we don't miss the educational moment. You said you really prefer to not be an activist, not to be active in the companies you invest. However, clearly, when it's called for, you rally all your resources and troops and do exactly what you need to do. And in this case, with Aimia, that actually was beneficial.
Right. I guess myself and then some of my friends created a lot of value. And just to be clear, we weren't a group. We actually didn't coordinate this. It just kind of happened organically, where we all said, screw it, these guys need to go. Speaking of activists, I'm not opposed to activists. There's a lot of bad CEOs, a lot of overpaid CEOs, a lot of truly inept and corrupt board members. These people need to be gotten rid of, and shareholders can't be victims. They have to speak up. At the same time, I see a lot of these activist funds that sit around and kind of go through lists of companies, and they're like, who should we target today? And it's kind of like an extortion racket. You guys do this or this happens. And, just levering up to pay a special dividend or forcing them to buy back overvalued shares. Like, some of that stuff doesn't make any sense. You have to be able to actually force real change through. And just changing the capital structure isn't always the best idea. And I've seen a lot of companies then suffer because of activists later.
Sure. So all of this thinking, all of this processing, all this stepping into activism temporarily led you to relaunch Praetorian Capital, correct?
Yes.
Tell us about that.
Well, so I'd closed my fund in 2013, and I decided to relaunch it mainly because of the Aimia situation, where I said to myself, if I'm going to own insufficient shares to influence the outcome, then I'm going to be the victim again and again. And I don't usually focus on very large companies. And with very large companies, if someone does something incompetent or criminal, you can count on an activist showing up. But when you have a company like Aimia, which was a 200 million market cap, it was just too small to interest any activists. They would have to go then buy 10% of the company, and that takes time, and it's only a $20 million position, and you're going to spend a few $1 million in lawyers, and your returns aren't going to be enough to justify it. And I just realized that if I'm going to be investing in smaller companies, I need the credible threat that you can swing a stick at these guys and have them take you seriously. You don't want the CEO just to be like, that's nice, you have an opinion, thanks. And so it just seemed like the logical thing to raise some capital.
Absolutely. And folks can follow that on your blog, correct? As you develop that?
Well, I don't talk about my hedge fund on my blog. For legal reasons, I can't actually. Mm-hmm. But if you want more information, just please email me directly.
Absolutely. All right. Well, I want to shift gears one more time, and I think we're going to run out of time fairly soon. But you're out and about in the world all the time. I know you've been a few places just in the last month or so. I'm remembering over a year ago when you just happened to be in Bishkek and you decided to go to the stock exchange, and the amount of information that you developed just from that small incident and the steps you took. That's just my preamble of saying, where have you been lately that is particularly interesting? So I just want our listeners, to get a glimpse of how you see the world.
So I travel quite a lot. I'm always looking for investment ideas. I think I've somewhat soured on the frontier markets versus the US just because you don't really appreciate the value of rule of law and liquidity and transparency until you go somewhere that has none of those. But I still go overseas quite a lot and look for opportunities. And this past month, I was in Cyprus looking at Bank of Cyprus. Cyprus is having a recovery, and Bank of Cyprus at the time seemed like the right way to play it. I wrote more about that on my blog. I was in Azerbaijan. I spoke at the Value X conference put on by my very good friend Isaac Schwartz, and spoke about value investing. He has a unique take on this in that there's a lot of conferences in Manhattan, and usually everyone just kind of has a beer or two and goes home to their family. And he wanted people to actually have a chance to network. And so he puts these conferences in places where you can't just go home. You're kind of forced to go out with other people and stay out till 3 a.m. Talking, which I think is a great idea. We drove around Azerbaijan with some friends afterwards. I went to Georgia and drove around there quite a bit, and just takes time to learn some of these countries and learn what's going on, what's the politics, what's the economics. I always try to reach out to prominent business people when I'm in these countries. It's amazing who's willing to actually sit down for dinner and tell you what's happening and how they see things. And it's a lot better than just reading Wikipedia or some travel guide or something. To have someone who's a prominent person in that country really take some of their time and explain stuff. And I've been amazingly lucky over the years that friends of mine who have great contacts set up great meetings.
Mm-hmm. Mm-hmm. So what were your conclusions on Cyprus?
So Cyprus is definitely recovering. That's for sure. They had a banking crisis. The banking crisis is abating somewhat. They still have a lot of NPE exposures. But what's happening in Cyprus that I think is interesting is that you have a population of just over 1 million people, which means you don't need a very big change in total GDP to have a very dramatic change for a lot of these banks, just given the denominator in terms of number of people. And you're seeing property values start to appreciate. When you think of a domestic bank, it's really a levered play on property. So what happens is they make a bunch of property loans. When property prices decline, a lot of these people actually have money. They just don't feel like paying their mortgage. And if property prices appreciate again, and suddenly the property's worth more than the mortgage, they get current in a hurry. So while the banks can sit there, and Bank of Cyprus has sat there for the better part of 5 years trying to solve these NPE exposure issues, the only way to solve it is you need property prices to go up, because you can't just yell at these people, pay us, because they just say we don't have the money. And then suddenly the property gets in the money in terms of the asset value being higher than the mortgage, and these people do have the money. And what's driving this is a couple of things. Cyprus is a very low tax jurisdiction in Europe. Tax evasion is always a bull market. And you're seeing a lot of corporates move to Europe to restructure. You're seeing a lot of corporates and individuals moving to Cyprus just for tax purposes. But Cyprus also discovered a lot of nat gas offshore. And you have quite a lot of investment into that nat gas. Even though it's going to be a number of years until it actually starts flowing, you're seeing large companies go there to put the infrastructure in place. When I was in Cyprus, I saw the offshore drilling rigs. I saw the supply ships. That's a lot of money going into that little economy. And that's the reason why there is a recovery. And that's the reason why these property assets are getting into the money. And that's the reason I went to go see Bank of Cyprus, which
Gotcha.
Incidentally trades at about 1/3 of NAV and about 1 to 2 times pre-provision income, which is abnormally cheap for a bank. Going back to what I originally talked about, the Bank of Cyprus went bankrupt. It came out of bankruptcy. It's since dropped about half since coming out of bankruptcy. And it's that exhaustion factor where it's been a number of years since it came out of bankruptcy. Everyone who bought in the bankruptcy or right after the bankruptcy, they just got exhausted by owning it. They had no performance. Their funds got redeemed. You have this exhaustion factor sets in because every quarter was the same. We had to keep increasing our reserves. We had to keep increasing our reserves. We made no progress in the NPE, more reserving. So that you have this exhaustion. And finally, when it does start to turn, and it is starting to turn, no one really cares. And that's usually the point where I start getting excited. just for anyone who's watching at home, Bank of Cyprus came public 2017 at about 3.5 a share. Today we're about $1.30 a share, and it's been pretty much straight down.
Oh.
It's not like it's not like a big drop. It's just kind of a fade.
Sure. All right. Well, hey, this is going to be the last question before we wrap up. You're joining us in July in Panama and at the Global Investor Summit. So when you get off the plane and you are heading your way to the hotel, looking around the city, what are you looking for? What do you see, or what are you hoping to see? What are you expecting to see? Just give us a glimpse of how you view entering into a new city.
Yeah, so I've been to Panama. I haven't been there in about 5 years, but I'd been there about 5, 6 years ago. And, Panama City's quite nice. My wife and I, we rented a car and toured around Panama quite a bit. Beautiful country, it really is. At the time, there were a bunch of retirement communities spread all throughout Panama that looked like they had ran out of funding and the sales offices were abandoned. There was a lot of construction in downtown that looked like it was slowing down pretty rapidly. It's not hard to figure out which direction things are going. You just need to see if the cranes are moving or they're staying still. That usually tells you if there's liquidity in capital. And at the time, the cranes weren't moving. So I'd be interested to see if these projects got completed, if the cranes are moving, if it looks like new stuff's broken ground. I think that's the easiest way to tell. In the end, in Panama, there's not much to the economy there. And a lot of it is financial system based, or it's retirement based. So if that's driving the economy, you want to see that moving.
Well, I'm going to ask the same question of you after your second day with us. So I'm looking forward to having you there and looking forward to hanging out with you. I actually want to build on something you'd said a little bit earlier when you were talking about when you were in Azerbaijan, the conference you were at, and your buddy, when he puts together conferences, he forces people to network. Well, we don't force people to network, but that's one of the cool things about the Obrus events is that we give people many an opportunity to spend time with each other and to spend time with our speakers like yourself. So I'm really looking forward to forcing you to hang out with. No, I know you'll love it. You wouldn't be coming to join us otherwise, would you?
Right. I mean, I'm excited to go. I actually have quite a few friends going, and I'm looking forward to it. Cool. It should be fun.
Cool. Any last words you want to share with us?
Nah, just keep looking for opportunities. There's always opportunities there. You just got to put the work in.
All right. Well, hey, Kuppy, I appreciate how you see the world. It's certainly educational for me, and I know it's educational for our listeners as well. I look forward to seeing you in July. So
I look forward to it too.
Perfect.